Here's something most first-time buyers don't realize. The same broker who helps you close your first $800,000 mom and pop facility is also working 8-figure deals with institutional players behind the scenes. And what those bigger operators are doing, it's not some secret playbook locked away. It's right there if you know who to ask. Matt Rosendale from Lindsey Self-Storage Group sits in that exact seat. He's watching the first-timers make the same 5 mistakes over and over while simultaneously seeing what the pros do differently. Today, we're getting him in to spill both sides. I'm Joe Downs, and welcome to the Self-Storage Investing Podcast. Matt, welcome to the Self-Storage Investing Podcast. How are we doing today?
I'm doing great. Thanks for having me. I appreciate it. Glad to be here and excited to see what we can dive into and share a little bit of secrets, but of course, not all the secrets.
Matt, I know you're a busy guy. So thank you so much for taking 30 minutes out of your day here to, just espouse your wisdom with our listener here. So Matt, you work with literally everyone from first-time buyers scraping together their first deal, literally, to experienced operators doing 8-figure acquisitions, like I said in the opening there. Before we get into the mistakes and the lessons that you see a lot of the first-timers make, hopefully not our students, but I know you don't just work with our students, but give us the broker's eye view. What's actually happening in the market right now that I can't read in a trade publication, let's say?
Yeah, sure. So I think, real quick, I'll tell you how 2025 kind of ended for us, if that's okay.
Yeah.
Despite what 2025 and 2024 and 2023, some of the challenges that we went through as an asset class, high interest rates and people not moving and crazy ECRI and introductory rates from REITs. We had a pretty busy year as a team in 2025. It started out a little slow and then kind of picked up towards the end of the year. We still transacted 1.8 million net rentable square feet in 25 transactions. 41 properties sold, one large transaction at $90 million, to your point about everything from the lowest to the highest. So
what was your smallest deal?
I'm just going to be a little embarrassed here, and I don't think I'm going to show it on, well, I could show it on the screen, but we do, every year we do a trip as a team. John takes us somewhere nice and warm. This year it was Key West. Last year was Key West. The 2 years before that was Mexico. And we do awards. And one of those awards, I'm not going to cuss, but we'll call it the Crapper King. And it's, the not that it's a bad deal, but it's the smallest deal.
Okay.
And you get an award for that.
I love this, by the way.
Yeah, it's great. Here, I'll show you the awards here in a sec. But I've won it twice, actually back-to-back years. This year, my smallest deal, I think, let me double check here. My smallest deal was $345,000.
So you did deals from $345,000 in acquisition all the way up to $91 million.
Yep.
Folks, I was not lying in my opening about who was sitting with us here today. So it's literally the full gamut. Now, I will tell you that while you won the Crapper King Award, which I'm sure has a much more
a little different
explicit name than that, and I'm sure that's just an inside joke, but what's funny about that is I'll bet you your client, your buyer of that deal, will be telling people for years how that was one of the best deals they ever did. Because everyone I talk to has done a deal, usually their first, that had a 3 handle, a 4 handle, or a 5 handle in front of it. And it wasn't followed by million. It was followed by 100,000. Anytime I talk to seasoned people, 4, 5, 6 deals in, whatever, or even if it was their first one, they're always telling me how that's one of the best deals they ever did.
Yeah, it was a good deal. Honestly, it was a good deal for both sides. And the seller owns a number of other sites too. So it just made sense. And the year before that, I won the award too. Do you want me to show you the award or
Yeah, I mean, we've folks watching on YouTube.
Probably going to get some crap for this, but here we go.
I love it. And what's great about that is that's, again, just a joke, a funny, probably motivational thing inside your firm. That what Matt just held up was at least a gold looking, maybe bronze, I'm not sure what that was, toilet.
Either one, yeah.
But that on the other side of that is someone's treasure, right? Like that $345,000 deal is probably going to make someone $300,000, right?
Well, look, so that deal, not to get into the specifics of that deal, but it's a value add deal, as most deals that are are in that smaller range are. And, for that buyer, it's very possible he turns that into an 800, 900 million
Even
dollar
more.
deal. Yeah.
Yeah.
So
I mean,
there's the
that's
upside
why
for that.
I'm not kidding. When I talk to people, they talk about what was your best deal? They always start out with that 300, 400, 5,000 or $500,000 deal. You won the Crapper King Award because you did a 345 to $91 million.
Yeah.
Amazing. It's the full gamut. What, tell me about coming into 2025 and now coming out to 2020. How did 25 meet your expectations, exceed, just kind of come at you from left field, completely different than you ever expected?
Yeah. So I think it exceeded our expectations, at least as a team. I don't know about the market as a whole, but as a team, it did. We were very active in the second half of the year. And, I think the market as a whole, we feel, not to segue into 2026, but with how 2025 ended and what we're expecting in 2026, we feel we see green flags, and we think that's how 2025 ended, both internally for us and as a self-storage market as a whole. We feel like there's some green flags heading into 26, whether that's Fed rate cuts, which, I'm really tired of talking about interest rates, but it is just where we're at right now and something we have to deal with in 2023, 24, 25. The challenge that those rate hikes caused, were people not being able to move and buy homes. And, if people aren't moving, that's what 50% of storage renters do use storage for, right? So what we're excited about and hopefully is something that we see in 2026 is those Fed rate cuts hopefully spur some level of movement with people being able to afford to buy homes. The reality is I think it's 56% of homeowners right now have an interest rate under 4%. So, they really need a little more attractive interest rate in order to move into another home. And then hopefully that spurs some of our occupancy and rates and in-place rates. And, I think we feel good about that. And then in addition to that, some of the things that we saw in 23, 24, and 25 collectively across, national storage metrics, the supply or the oncoming new square feet, new buildings, new developments coming in, that has declined since 2021, pretty heavily in 2024 and 2025. The reason that's good is it helps those markets that are dealing with some supply issues kind of that supply absorb that occupancy and kind of backfill that in. And once they absorb occupancy, hopefully that means they can raise their rates as well. So kind of seeing some of that in 2025. And I think that's we'll continue to see that in 2026. Obviously, somewhat market specific, doing that wholly, right? So somewhat market specific in that regard too.
That's really good insight. Along those lines, I was on a podcast as a guest yesterday,
Yeah.
and I want to ask you a question I was asked.
Oh, no.
All
Okay.
right.
Hey, you're smart, so I don't know what to expect here.
Well, I'm hoping I gave the right answer. I don't know why I'm assuming you're going to give the right answer. Well, we'll see. All right. So seller psychology, right? Have you seen a shift from the 21, 22 anchoring? For anyone listening who might be listening to storage and just, starting to dip your toe into it and you don't know what I mean. In 21 and 22, there was the COVID effect, right? Occupancies went through the roof, with it went rates, and then valuations because of NOIs. So we had sellers who knew, or well, they knew if they had sold then, but had expectations of certain valuations of their facilities, didn't pull the trigger in 21 and 22. 23 and 24 was a completely, my expression always is COVID giveth to storage and then COVID taketh away. And I remember, and I know you do, and then and you just kind of touched on what else happened in 23 and 24 with just that period of stagnation where nobody moved. So COVID tooketh away, occupancies came down, they weren't filled back up by people moving. So it was a tough, really 2 years was with the interest rates going on. Everything conspired against us, yet we still all survived. which is another reason why we love self-storage. Is the seller mindset still in 2021, 22, or has it adjusted
Yeah.
to the new reality?
Yeah. No, it's a great question. It's a loaded question, and it's a question I get relatively often. Oh, yeah. I mean, to your point, 2021 was a wild year, and the first half of 2022 as well. And those interest rates, bucked up in the second half of 2022. So, a couple things. The short answer, I think, for the most part, yes. Although you're always going to have people that are going to hold over to a price they were told 4 years ago because that was the highest price they've ever been told. So, I think that there will be some of that. For us, the beginning of this year has been the busiest Q1 we've had, maybe ever, at least since 2021, which, what we just said, 2021 was,
That's saying something.
yeah, 2021 was a pretty crazy year. I think what I'm seeing with that is, when we do valuations, I try to be as accurate as possible. And I try to be as honest as possible about what I think the property is worth. Ultimately, the market will determine that. But I look at it from a buyer perspective. That is, what are the returns? What's the IRR? What cash with cash on cash? What's the cash flow? What's the NOI? All of that good stuff that I'm sure you've talked about on many other podcasts here, episodes. But I try to be as honest as possible. And most of the valuations that I've been doing, or a good portion of them, they aren't at 2021 values. And the reason for that is because interest rates are higher. So revenue may or may not be the same, maybe a little bit lower, maybe a little bit higher, depending upon the market and the actual site. So I try to give that feedback to our clients with actual expectations of what to expect from the market and from buyers. And the truth of the matter is, a buyer can only pay what they can afford unless they're paying all cash for everything, right? So if you're getting financing, the deal needs to make sense. Can it have a little bit baked in order for some value add? Yeah, sure. But at the end of the day, it has to cash flow. It has to make sense. So that was a very long way of answering your question, but I do think that expectations have changed. And I like to think I'm a little bit part of that just because of how I approach doing the valuations and that giving those realistic expectations. Now, that being said, there are some other deals that still go out there, not generally from us, that are a little higher and maybe a little tougher number to get. And I think some of that is still residual from 2021 expectations. So I hope that answered your question. I think it's a combination of both, but I think it's the fact of the matter is that the market has changed, and you know,
Yeah, we gave the same answer. The only thing I added to it was you have newer sellers that weren't for sale back then and never priced their facility, never asked, or if a broker called or if I called to see if they were interested in selling, they just said no. So they never really knew what their valuation was.
sure,
And again, I'm talking about the mom and pop facilities, not somebody who listed it as a mom and pop, got a valuation. Clearly they know that. And I'm talking about the people that never went through that process and didn't really have a firm understanding. And then the other thing I said was even those, and I agree with everything you just said, because we still have some that are still anchored. But even I've seen some that are anchored, at least, that the 1 foot's anchored and 1 foot is in reality, which is, unfortunately, people are older. And that was 3 years ago. And if you were 75 3 years ago, thinking you were getting 3 million for your facility that was worth or is worth 2.2 today, because that's what the numbers say, and your wife just died, or you just got a bad diagnosis, where life happens too. And then that helps change your perspective and on everything. So I think all of that conspires together to change the outlook in general of sellers, looking across the full market of sellers, whether they had an idea of what it was worth or not. I think we're in a different place. And all this, by the way, rolls up into my next question, because you started to kind of give I'll call it a more positive outlook for 2026. I personally say, don't run around saying there's a tailwind off the record. I think there's going to be one, but I can't say that on the record. On the record, I can say and feel comfortable saying feels like there's a little bit of a bay breeze. I don't know about a tailwind, but a bay breeze, and we'll see what happens. It certainly could devolve or evolve, I should say, not devolve, into a tailwind. So all of that said, the question is this a good time for a first-time buyer to jump in, or should they be patient?
Sure. Yeah, I might be hesitant to say tailwind too, but I'm kind of the same ilk as what you're saying. And part of that is just how busy we've been to start this year and the type of valuations we've done all over the board. So, yeah, I mean, for a first time buyer coming into a market like this, I think I'm kind of a proponent of, and Joe, I don't know if this makes sense, but I'm kind of proponent of you can find a deal in any market. Now, it might be harder in some markets as a whole, right? And easier in other markets. But I'm a proponent of you can find the right deal for you regardless of what's going on. It just might be a little bit harder.
When you say market, you mean market cycle?
Yeah, I apologize. Yeah,
Yeah,
yeah.
yeah, okay.
Market cycle, right.
Yeah, I just want to make sure the listener understands. Okay. So, and I agree with that. I agree with that. The only thing I add to that, and this is just my take on it, is I still think you're potentially buying discounted trailing 12s compared to what they will be. And that lends me to believe I agree with what you're saying, but I feel like it's a little extra special right now.
So
Just a little bit.
no, that's a good point. And I think that's a good point. And I tend to agree. Just of all the sites that we look at on a weekly, monthly basis, you know, some of them were suggesting, hey, hold on for the next through spring lease up, hold on for the next 6 months, hold on for the next year, kind of see where things trend. To your point, if we feel that the market is slightly shifting, and we see some of those Fed rate cuts, and we see people start moving and buying homes, and doing the things that they do to rent, sell, storage, then the ideal situation is that occupancy goes up. In turn, the rates also go up with that occupancy, the in place rates, and then of course revenue as well. So to your point, yeah, I mean, I think that could make sense. But again, it's so deal specific too, right? Like I always hate doing not hate, but I always have a challenge doing generalizations because it's so deal specific. And I underwrite these things all day long and I like doing it. So huge on that, like it's deal specific thing. I
Well,
apologize if I'm not like super clear.
unfortunately, this is where we have to be general and not specific because
Yeah,
we're
I
not
know.
talking about what was the line for Mission Impossible? He says it's difficult. And he goes, well, difficult should be a walk in the park. This is
Yeah.
Mission Impossible. Difficult should be a walk in the park for you. So, all right, let's get tactical here. You've worked with a lot of first time buyers. True or false?
True.
I want to know what the patterns are. What do you consistently see? And again, this clearly not from our students, but what do you consistently see them get wrong? And maybe you're even a little tired of watching it. Feel free. This is where you can be a little reverent if you want.
Yeah. So I
Or
will say,
irreverent, I should say.
nice vocab word. What I will say is, I think a lot of people, and not that I've done this too. You look for the perfect deal, right? So you come up with your criteria. You come up with, okay, I want to buy this size site. I want to spend this much money. I want to be in this type of market. I want this. I want this. I want this. And you craft this perfect deal. And then you judge every deal based on that perfect deal. And then you don't end up buying anything because you're trying to find the perfect scenario. When in reality, that perfect deal probably doesn't exist. And if it does and you found it, power to you. I mean, I have seen that happen. But generally speaking, it just needs to check a good portion of your boxes that you're content with to buy that asset.
You nailed it there. And this is a problem with our students, at least early on, is if we give them 5, 10, this is what the deal, this is what I look for in a value add deal. There's no marketing, there's no this, you name the 5, 6, 7 things. They think they need to check every one of those boxes. And if they don't, it's not a good deal. And they bring them to like, well, what happened to that deal well, it didn't have, one of those. What are you talking about?
Sure.
Like,
Yeah.
that's a great deal.
Well, and it makes sense, right? I mean, I get that, but that's probably, I think I've been saying, I'm the first person to think of that, obviously. But I've been saying that since I got into this. I've had people, or I've had some clients who've been looking for deals for 6 years.
Man,
right?
it's just analysis
None of
paralysis
your
can't
none of your none of your students, though.
better not be. Yeah, but it's just analysis paralysis. They can't get out of their own way. Yeah, it's so hard to watch. And we've seen them walk away from really good deals and it's sickening because it's so hard to find the deal and get to the point where we're having that conversation, a relationship with somebody who's sitting on a really good deal that wants to sell and you're working with them and then you let them go. All right, that's a great one. Great one. What else are we seeing? How about walk me through how a first timer should actually research new construction in a trade area?
As far as looking for new supply that comes into the market.
Yeah.
Yeah, so I think, I don't know if I'm allowed to say specific companies that we use for
Yeah, whatever you
aggregation
want.
data,
Yeah,
but
the genesis of my question is a lot of times they forget to check the supply pipeline. So how do you go about talking to them about, "Hey, that's great, you got this deal," or it's your listing and you're working with them?
sure.
Are
Yes.
you doing that for them, or are you making sure they understand that they need to check the supply pipeline?
So that's great. So I think a few things. One, we use a couple. There are a couple different websites out there that you can use, like Tract IQ, Radius Plus, Store Track, and we use a few of those. And I'll use that as like my first go to for looking at supply in a market. It'll give you the square foot per capita and a list of those potential developments. If I want to dive deeper, I'm calling the county or the town, whatever, or the municipality, whatever makes sense, confirming whether or not those are actual in process developments. And we do put that information on our offering memorandums, and I have it available too if it's not on the offering memorandum that we do put out. But I mean, it's calling and confirming. It's one thing to just to look and say, "Hey, this is a potential development. Let's confirm that it actually is something that is moving forward," because data changes daily. That's to me probably the best way to do it. You're kind of essentially calling the horse's mouth, if you will.
Any of your first time buyers ever fumble the football with, the mom and pop to professional management, switch over, crossover, changeover?
Yeah, yeah,
What happens there?
yeah, of course. That can happen. Just to make sure I answer your question. So you mean more so like the actual management of the facility, right? Like the day-to-day type of. Yeah.
Well, it starts in the underwriting.
Okay. Yeah.
Yeah, just the conceptualizing it, looking at a performance and saying, "Oh, it only costs, just use ratios 20% to manage this facility." Do they struggle with understanding that no, 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 unless you live down the street, it's going to cost you more like 35% or 40% to manage this facility? Do they struggle with that when they're looking at performas?
Yeah, so that made me think of something that I that a lot of first time buyers sometimes when they call me and they have this notion, or some people have this notion that storage is easy in that, it's a great asset class. I love it. It's all I do. I don't know anything else. Right. So they call and, this conversation goes something like this. Hey, I want to, get into storage and, think about doing it for the first time. Heard it's a great asset class. I heard it's really easy. Like I got to buy it. And I just, you know, the checks keep coming in. Right. Well, the answer to that is, well, no, take some elbow grease. Like you got to learn what you're doing and you're going to make some mistakes. And it's a little more forgiving than some other asset classes, but you got to learn how to run the facility.
It's still business.
It's still business. So to answer that question more specifically, I think that it depends on the site. And again, I know I'm going back to my broad strokes here and not broad strokes, but
You got to give us some juice. I'll allow enough CYA in there.
yeah. So if it's a smaller deal, a third party management may not make sense, right? So you need to have some kind of plan as to how you're going to manage the site. Are you answering the phones? Are you hiring a call center to answer the phones? Are you going to have what I would call, I think it's a pretty common term across the industry now, a boots on the ground that's going to go out to the site once a week, twice a week, do overlocks and all that good stuff, to clean out units, make sure stuff is good to go to manage that yourself, then you have to know what you're getting into. Well, first off, you have to find that person, right? It has to be the right person to handle that. You have to trust them if you're not close to the site. And then if you're hiring a call center, you want to make sure that they're doing the right type of calls for you and actually answering the phone and doing everything they're supposed to do. And if you hire a third party management company, you're going to have that increased cost, but the idea is that they're going to be able to do that for you, right? To a degree. You still have to have some oversight because um, always have to have a little bit of oversight on your asset. I think you should. So I hope that answered your question. I think the mistake is probably more assuming that you're going to find somebody cheaper than what you actually can find somebody for a boots on the ground. And then, the third party management companies, there's a lot more of them out there now than there were 2 years ago, 3 years ago, 4 years ago, 5 years ago. And they all charge different ways of charging and different ancillary fees and different add-ons and things like that. I think
No,
it's
you did answer it, because what I wanted people to hear from the broker's mouth is, because they're either talking direct to a seller and they're getting their expenses, or they're looking at an OM, and I know there's no OM that comes out of the Lindsey group that doesn't account for the very likely increase in expenses to manage that facility, because it's going to be managed differently. But in the industry, Matt, believe this or not, there are a lot of OMs that float around that don't account for that. And I think a lot of first time buyers don't know that or recognize that. And then when they're going through their motions of underwriting their facility, lining up their financing, understanding it, again, not our students, but first time buyers out there, because we see it, they don't appreciate what you just said. So thank you for sharing that, because unless you're the neighbor, unless you're going to run it exactly the same way that the seller did, your expenses are going up. They
Yeah.
have to.
And and to your point, I think I'm just so used to underwriting these things that these sites that I know what I'm going to put. Like if they don't have an expense for a manager, I know what I'm going to put in before I even do it, just because I'm so ingrained in underwriting these sites. So it just depends on the size of the site. But yeah, you can't, unless you're going to manage it yourself, which is fine. But fact of the matter is that, it's tough to find a site 2 hours, 3 hours from you. Talk about limiting your criteria, right? Even though that's great. If you can find it, it's great, but it may not be the perfect scenario in that regard.
Matt, this has been awesome. I'm going to let you tell people how to get in touch with you in a second, but first, you've got to give some value for them first. Not that you haven't given value this whole time, but last piece. What is one piece of advice you would give someone who hasn't pulled the trigger yet, or they're listening to this podcast and they've been dancing around thinking about self-storage, haven't pulled the trigger yet? What's the one single piece of advice you give them to get started?
Yeah, I would pick up the phone and make a call. Pick up the phone, make a call, whether that's to me, and I'm happy to throw my phone number out there too. Whether that's to me and saying, "Hey, what do you have available?" Or if it's even just, even though this is like creating competition for myself, picking up the phone and calling an owner and seeing if you can strike up a conversation, see what they are looking for and what their goals are, and maybe you can help them, you know, achieve their goals for this year of selling their facility. So just pick up the phone.
So basically, take action.
Yeah, pretty much. Yeah, you said it much
Just
better than me.
do something.
Yeah,
right?
right.
Folks, I would encourage you to call Matt. Matt, where can we? How do we reach you? Either at the Lindsey Group, or what are you giving out? Your cell phone, your email?
Yeah, I'll give you my cell phone. It's plastered.
Social security number.
Well, I'm not going to do that, but I'll give you my cell phone. It's plastered everywhere, just like my face. So, although this face looks a lot different than I think what's going to show up on here, so that'll be really funny. Yeah, I'll just give you my phone number.
Yeah, you got your winter beard on.
Yeah, winter beard, long hair. The wife doesn't like either of those, but I've always wanted to have longer hair.
We will put it in the show notes, but for people listening, go ahead.
Yep, 484-695-0872, and go Bills.
Oh gosh, I had to ruin it with that. And what's your email?
Matt, M-A-T-T, at
Josh Allen's biggest fan at Gmail.
Hey, you know what? I all you got to do is look at my background. It's all there. I had to get it in. I'm sorry.
You Bills fans make us Eagles fans look great.
Now, you're going to edit some of this out, aren't you?
Nope, it's staying in. What's your email?
It's Matt, M-A-T-T, at lindseyselfstoragegroup.com. That is Lindsey with an E.
So LINDSEY, selfstoragegroup.com. So Matt at lindseyselfstoragegroup.com. And as we're closing the show down here, I saw a text across the screen from our producer, Doug, who says, and I agree with, he even looks like Josh Allen.
Dude, so hey, that is hilarious. I have gotten that before, and I will take it.
If you want to check out the self-storage Investing Podcast on YouTube to verify or disagree. Feel free.
You should do a vote. You should do like a
Yeah,
there
here
you
we go.
go.
Now we're getting interactive here. We're going off the rails here, folks. Thanks for listening. Hopefully you enjoyed the interview here with Matt Rosendale, one of the best in the industry, with the Lindsey Group. We work with them a lot. Our students work with them a lot, and I highly recommend you pick up the phone or shoot Matt an email. Very approachable, very easy to work with. Certainly will guide you right into your first deal. And if nothing else, just get on their list and start looking at their deals. They will spam the heck out of you, but that's okay. That's what you want. That's why you give them your email. And it's great to immerse yourself in the self-storage space. If you're just looking at it now, start getting those emails, start getting those OMs in your inbox and looking at them. And the one thing I always tell people, Matt, in every one of those OMs, there's a deal for sale and 5 potential leads in the comp section.
Sure. No, you're right.
Where you've done all the work for us. So we appreciate it.
I'm calling them too.
And we know you're calling them. I'm Joe Downs. Thanks for listening to the Self Storage Investing Podcast. We'll see you next week.
Thanks, guys.